you'll see prices go up.
Trump administration wants to drop all property tax.
Am I really going to get out of my 2 to 3% interest rate? Still watching inflation pretty closely.
It's basically unaffordable. Double of what the actual salary is.
Yeah.
What kind of income you're supposed to have to buy that type of house? Hello and welcome back to 3D Media Life Podcast. Today I have a special guest, Audie Gardner, and he's with West Coast Capital Lending. He's a branch manager, and we have a very fun topic to discuss today, something that's been on the minds of a lot of people.
Yes.
Borrowing to buy a house.
Absolutely.
And in general, the housing market, which is absolutely bananas today.
It is.
Yeah, I've been trying to buy a house for a while, and I've been communicating with you back and forth, and we still haven't reached the destination yet, but I think close.
Knock on wood. Knock on wood. We're close. Yeah.
Tell me, like, how many loan applications you're doing now versus years in the past? What's going on in the market right now?
So, what we're seeing, obviously, affordability when it comes to new home purchases is, the biggest challenge most people face. With the drop in rates during the pandemic, obviously everyone fled to different areas. Affordability increased, which drove values up, right? So it was an inflationary environment. What we're seeing a lot more of now is, typically move up or move down buyers. Maybe people like yourself that have established businesses, been saving for a while. The opportunity and timing is finally right, but not everyone fits into that bucket. So, if we look, the majority of what we're doing right now at West Capital Lending really is restructuring debt. So people that bought have a tremendous amount of equity with, everything that's occurring as far as how expensive things are today. We're trying to help restructure credit card debt, other high interest debts. The purchase market seasonally over the last 9 months has actually picked up a little bit, but it's still down from a year ago. And really it's driven by the rate drops that we've recently seen. So you can see there's a lot of buyers out there waiting, but it's an affordability issue.
Yeah. I mean, like, even in the city that I live in, Irvine, it's average salary I looked up, household income is about $140,000, $150,000 a year. Average price of a home is, I think, $1.82 million, something like that.
Yep. What
kind of income you're supposed to have to buy that type of house in a normal loan with 20% down payment?
For a conventional type financing, right? Or depending upon the size of the loan, it might be just outside of conventional. But typically, if you're putting 20% down, assuming you have no other debts, that it is the home.
Which is never the case.
Never the case. But I would say, to be safe, you're probably somewhere in the upper 200,000s to 300s. If you have other debts like cars, credit cards, student loans, 350, 400,000 in order to buy a house in that market.
So in the best case scenario, there's still at least a $50,000 to $100,000 gap in income.
Yes.
From the average to the average income to average house prices.
Yes.
And in normal case scenarios, it's even like upwards of $200,000 gap. Yes. Which is double of what the actual salary is, which is crazy.
So the challenge that you have to interpret too on the data, and data can go down so many rabbit holes, is, we also lump in people that might be in that, 16 to 20-year-old bucket. It does drive that median income down. If we're looking at people, more in their 30s, the income average is a little bit higher. But again, clearly with the slowdown, in home sales, affordability is still, the biggest driving factor holding it down.
But I think the number that I pulled, and I want to double check this so I'm not taking stuff out of my head, which may be inaccurate. I think it's household. So it's taking into account the whole family. The husband, wife, probably children included. So it wouldn't even matter if you have 16-year-olds or not. It's the household. Let's see. Household income. Yeah, 129,000 to 133 in Irvine. Far off. That's 2023. Let's say it's more like 150. It's basically unaffordable.
You're right. The other thing that you have to take into consideration, I grew up in Irvine. I know it very well, right? There's pockets of Irvine that are aging. So you do have an aging portion of that community that's also on Social Security. So that does drive those numbers a little bit as well. Because as the population ages out, people are no longer in their earning years. They're relying on Social Security, and that's what's getting reported into that median household income.
Yeah, but let's say majority of people can't buy the conventional way. And it's probably true across the country, too. It's not just, we're in a bubble here that's Southern California that's bananas.
It is.
But still, a lot of the countries like this, all the coastal stuff, all the major cities, New York is completely out of control too. Manhattan is. I looked at the average home prices. I think Manhattan is the number one in the world as of today.
Yeah. And you did this today? You looked? I don't do business in New York, so.
No, I checked a couple of days ago. It was, I believe, number one in the world, average home price in Manhattan.
Wow.
Yeah. I think America actually has few on the top of the list.
Oh, yeah, I'm sure.
And that created a problem. Like people are, if I'm not mistaken, the lowest amount of loan applications too, right? But it's going up now, or?
So again, what we're seeing seasonally adjusted, right? Because typically this time of year, there isn't as much activity. Usually we're going to see stuff in spring and summer months where more homes get listed, and we do start to see, more opportunities for people to buy homes. And usually buyers are more receptive to move around spring or summer, especially if you have families and you have children in school and you could be changing school districts. All those things come into play. But mortgage applications, we've seen every time they've done a rate decrease over the last few cycles, we have seen applications for purchase mortgages go up. That doesn't mean they're closing on transactions. I think a lot of people are directly correlating that drop to a interest rate that would drop by that exact amount. And one of the things that's confusing when it comes to mortgage interest rates is, it is not typically tied directly to, Feds cutting the rates. It's tied to the 10-year Treasury. Now, when I say tied, it mimics the 10-year Treasury. There still has to be an appetite in the marketplace for people to buy mortgage-backed securities. And the one thing the Fed has said here recently is, since 2008, they've been doing a lot of quantitative easing, meaning the number one buyer of mortgage-backed securities has been the federal government. What has that done? Has kept interest rates artificially low for an extended period of time. They've come out and said over the last couple cycles that, hey, we want to start pulling back on the quantitative easing and get out of the mortgage-backed security game, which means now private investors like you and I or anyone else that might be in a position to buy pools of mortgage-backed securities. And I'm not talking, tons of money. It's individual investors or institutional investors buying these products. They want a higher rate of return than the government was willing to accept. So even though the Fed might be dropping rates, they're also slowing their purchase of mortgage-backed securities, which is keeping rates from dipping like they did in the past.
Yeah, where are we now? Today is what, January 7th?
January 7th.
And where are we now?
Rate-wise?
Yes.
I'm seeing more and more people in the high fives, low sixes for conventional type financing on a 30-year fixed.
Which is starting to be like more or less historical average.
Correct. Right? So we're getting back to some of the historical averages, from where we were. If you went back a year to 2 years ago when we first saw the spike, 7% plus was not uncommon. So, there is quite a bit of movement. Considering how many rate drops we've had since they started the rate drop cycle, I would have guessed, and I think anyone in my position would have guessed, we would have saw, a larger decline in interest rates, but they are coming down.
Okay. Where do you think we're going to be in a year from now?
If you would ask me this question, I would have probably given you the same answer. But, as it stands today, the Fed, is still watching inflation pretty closely. But, some of the leading economic indicators, have shown some cracks in the economy. The intent going into this year was that there would be 4 additional drops, anywhere from 1/4 to 0.5% per drop. But every time they make that drop, they also say, well, we're not sure we're going to do a drop, in the next session. Ultimately, the last 4 times they have. So I think that will probably continue. But again, I'm throwing darts at this stuff because there's a lot of stuff going on globally that could impact, things that could affect interest rates. But the plan right now is 4 more drops for this year in 2026.
And also, I've noticed we still have artificially low amount of inventory on the market. Mm-hmm. So I feel like because of that, the prices for real estate have not dropped as much as they should have. They have not corrected.
Yeah.
Because most likely, and we've discussed this before, people that are locked in on the low interest rate just can't move or are afraid to lose their 2-3% that they got during COVID and put their house on the market to change locations, relocate, or upgrade, downgrade, whatever it may be.
And you hit on something, at the start of that. Yes, the rate is difficult to let go of. The other thing is the property tax rate. right? For a lot of these folks, they bought their house years ago.
Right.
So if they're selling a property, taking that equity, throwing it into a new home at a higher purchase price than where they were at on their current home, taxes are also going to go up.
Yeah.
Additionally, the other thing is, like you said, there's not a lot of inventory. So am I really going to get out of my 2 to 3% interest rate with a much lower, property tax rate exposure to get into a property that I don't love, right? So unless there's some needs-based reason to be moving, I don't see a lot of people, making a change as it stands today with limited inventory.
Yeah, this is always going to be a problem with supply and demand.
Mm-hmm.
The problem today for both of us in our industry is it's not just the supply is the issue, the demand is the issue as well.
Yeah.
There's less buyers and there's less homes for sale, and the market's very stagnant.
Yes.
I heard for realtors, it's even worse. I know for a fact we have about 2,000 realtors that work with us.
Yes.
And a lot of them
Mm-hmm.
have not had a listing in over a year.
No surprise.
How can you live?
You can't.
You just can't.
You can't. And I would bet that if you look at the people that are continuing to renew their licenses over this period of time, you've probably seen a fall off in agents.
Oh, there's going to be a massive fall off.
But the interesting part to that is, some of these people that did really well previously that have, built a business on a solid reputation and have kind of taken over certain markets, they're still fairly busy considering, but doesn't leave much left for those people that might have done a handful of transactions a year outside of maybe some friends and family that, might do something.
And even friends and family are sitting there doing nothing.
Correct.
Yeah, it's a tough market. I think a lot of the purchases that are being made are still probably institutional.
Mm-hmm.
Would you say that's true?
I've done some research on this data because my wife and I go back with this. And you see a lot of this stuff online that, institutional investors are buying up single family residences. According to the data, it's not nearly what I thought it was and what everyone thinks it is. I think it's still under 1%. Fact check me on that. But it's not as many as you think.
As of today. What about 2 years ago?
It still wasn't as big as everyone made it out.
I feel like BlackRock.
They were.
Zillow used to buy homes. Open Door used to buy homes.
They did. I don't think even during that period of time, it was as big as, private buyers. Not even close.
Really?
No.
Yeah. I thought it was always.
Again, fact check this. But I don't think that was really the case.
And also a lot of foreign investors. I think the Chinese are coming in with cash and buying up houses.
So that was a big thing and continues to be a big thing. But I feel like that's slowed down with China's economy starting to waver a little bit. I don't think we're seeing as much of that happening with the cost now to get in here. It's a little different. But here in Irvine specifically,
oh yeah,
that was a big part of the market, over the last 10, 15 years that you had, foreign investors moving in and buying, cash, which also drove the Irvine market up more than other places because of that. Cash offers were a big thing during, 2020 and the pandemic, but the Chinese market was doing that before that happened. A lot of people coming in with cash.
The Chinese, it's cultural for them to buy up real estate.
Mm-hmm.
Like even in China, they buy up stuff that doesn't even exist yet. And there was like almost like their own real estate bubble where they would have crazy amount of construction.
Yes.
And people would just, as a family, gather as much resources. Yes. Everybody has to own something.
Yes.
And they would buy stuff that was never built.
Yeah. I think, did you see this on 60 Minutes?
No, I just looked up other random
stuff. There was one I watched occasionally. There's some things that pop up and I saw this. It was clipped, so I watched it. There were high rises being built all over for no one to occupy, right? And these were getting bought up, and it was a massive bubble that ultimately ended up collapsing because they didn't have, anyone to move in. So people were buying just for the sake of buying, but there weren't people, tenants to be able to put into those properties or even people to live. So you have, massive construction that, never had any occupants.
Yeah, they have like all these ghost cities.
Correct.
Still. They're
Correct.
Empty, vacant. Yes. Nobody lives there.
Yeah.
And a lot of them are unfinished, and I don't think they'll get finished anytime soon.
They're
just rotting away.
Yeah.
It's crazy. But that mindset carried over into the United States because we're such a stable market here.
Yes.
They want to invest their money. They want to own property, which is very admirable.
It is.
However, I have my personal opinions as a buyer.
Yes.
I think we should, as in a lot of other countries, limit that.
Yeah.
Why?
Foreign ownership.
Exactly. Try buying something in Vietnam.
Yeah.
You're not going to be able to, unless you have somebody local there that's sharing the ownership
Yes.
with. I think China too. I think foreign investors are a little bit limited. I'm not 100% sure on that.
I don't know.
But a lot of countries have that.
Yeah.
You want to give your own citizens the ability, especially first-time buyers, for
Yeah.
example. And the easy way to solve that is you just create a tax for foreign investment. You don't stop it altogether.
Yeah.
But you disincentivize, just like you put tariffs.
Yeah.
So you have local made goods and prompting up local economy.
Yeah.
You put taxes like property tax for foreign investors.
Yeah.
Domestic like residents, especially first-time house owners, maybe no property tax.
Yeah.
But second, third, fourth property for sure have a property tax.
Yeah.
That would allow everybody to be a homeowner. It's such a simple solution. In fact, I heard actually recently, I don't know how true this is, Trump administration wants to drop all property tax. Have you heard of that?
I've heard a few things. I'd love to see some of these things come to fruition. I don't know what that trickle effect does to everything else. We've heard income tax elimination. We've heard property tax elimination. I don't know how easy that's going to be. I mean, when you look at it from a local level, property taxes, typically
It's for all the schools, roads, everything.
and it's the county managing that, right?
Yeah.
So I don't know how you pull that off. I don't know above, my understanding of how you would navigate that on a federal level. I think some things should still be managed at a local level. I think, the local boots on the ground are going to have a better understanding of, what's going on locally than have to now try and manage all of this across the country from afar.
Yeah. Florida also, I think DeSantis.
I have heard that.
Do that.
Yeah, I have heard that.
That will probably make the prices shoot up quite a bit.
It will. I think, the intent here is, homeowners insurance there. I do a lot of business in Florida year over year because of the hurricanes. I'll do a loan for a client today. They'll buy another property or refinance their existing one. It's double what it was the year before. And
Wow.
I'm seeing people that now have $20,000, $30,000 a year in annual homeowners insurance.
And I heard homeowner insurances are dropping coverage.
Correct.
Too after the fires.
Same thing here in California, right?
Earthquakes.
Yeah. In California, insurance companies were limited on the amount that they could increase premiums. And that's why you're seeing a lot of people exit, which then leaves it to the California Fair Plan to make up for the fire insurance portion. And then they'll insure the home, for everything outside of fire. But yes, you're seeing, a lot of places being dropped. I mean, I have multiple family members that I've had, including my mom, that I've had to find, alternate options for insurance because no one would insure.
That's kind of like the socialist approach.
Yeah.
You'd force companies to keep prices lowered artificially.
Yes.
And for them, it just gets to a point where it just doesn't make sense anymore to operate.
Yeah. And
you're left with an even worse situation that
correct.
you try to correct.
For the consumer, it's, oftentimes worse too. Anytime you are managing all of this stuff from a non-public entity, meaning government, I feel like the red tape continues to increase. And people already struggle when it comes to, insurance claims, medical, homeowners, auto, you name it. But I feel like typically the private sector, because there's competition, does have to do a good job servicing their customers. Whereas if it's managed by the government and you have one choice, this is what you get.
Yeah.
Right? You have nowhere else to go. What are you going to do? We work at the pace we work at. We approve what we approve. It creates, the lack of competition in the marketplace.
Yeah. I'm a firm believer in free marketplace.
Yeah, me too.
Let the market figure it out.
Yeah. And the consumer will decide.
Yeah.
Right? If you don't have a product that is superior or a level of service, to solve an issue, all the things, the consumer's going to go somewhere else.
Okay, let's get back to the actual numbers here for a second.
Okay.
So today the options are conventional loan, 30-year fixed, which is at about 5.5, right?
5.99, right? 5.99 looks good. We're somewhere around the 6%, give or take.
You can do 5.5 today.
So typically what I'm doing right now,
perfect credit,
and no, not at a par price, meaning without paying points or doing some type of short-term temporary buy down. The caveat to that is going to be FHA. You could probably get there, right? However, you're going to have monthly mortgage insurance, which essentially raises your rate by 0.5%. So you end up still at 6%, even though your mortgage interest rate is 5.5%. And then you're going to have the upfront mortgage insurance premium, which is 1.75% as well. So on a conventional loan, 5.5% is difficult to get to without paying points.
Got it.
Yeah.
And then the other route,
Mhm.
which I was exploring myself,
Mhm.
because on a business, it's
Mhm.
hard to
Yeah.
show like significant profit when you're trying to have a good business and
Yeah.
plenty of write-offs,
Yeah.
etc.
Yes.
The other route is bank statements.
Mhm.
That's been a lot more popular lately than it used to be.
It is. We had it in, prior to the 2008 collapse. It went away, and I think we've tightened up on how we use that today. So the requirements are, a little bit, you have to fit a certain profile that previously we didn't. So we're starting to see that more and more, especially in high income areas like this, Orange County. For example, you do have a lot of self-employed individuals that do very well, but they take advantage of, the tax code just like everyone else does. So there's opportunities for them to minimize that tax burden. If they go that direction, then we're going off the tax returns, and that income oftentimes won't support the ability to service the debt. So we leverage bank statements. And bank statements, essentially we look at the deposits. We want to make sure that, there's always enough money in the account. And we're going to take a certain percentage of those deposits, factoring in an expense factor based on your line of work, how many employees you have, to make sure that we're not putting you in a bad position when it comes to, getting the financing and you're actually going to be able to pay the debt. You do have to come in with money down. On those bank statement programs, you also need to have reserves. So on the conventional route, dependent upon the loan to value, you might not need reserves. So, it does require, the barrier to entry is I got to make sure I'm putting enough down, and I got to make sure I have enough to weather a storm over a 6 to 12 month period. That's the caveat to the bank statement loans, and you need good credit.
And then the other downside is it's higher rate.
Typically, the rate's going to be higher because
Half a point.
Yeah, you're probably about a half a point. That's going to be higher because ultimately there's more risk to the bank. It's not backed by Fannie Mae and Freddie Mac. So whoever the lender is or whoever the investor is putting the money up carries a little bit more risk for that product.
And then the other option is interest only.
Mhm.
And you and I have had a conversation about that.
We did.
So interest only allows you to have lower monthly payments.
Correct.
But in the long run, it's a lot more expensive. So it
It
makes
is.
sense for people that are buying this to refinance later if they know for sure
Yep.
the rates are going to drop and
Yeah.
they're going to refinance anyways.
Yes.
Like maybe 2 years ago or a year ago when it was like the highest rates possible and for a fact it's going to drop by 2 points or something.
Yeah.
That's like a no-brainer.
Yeah.
You carry the cost of the interest in the first
Yeah.
2 years. The math adds up when you refinance.
Yeah.
You made it a lot more affordable for yourself and then just refinance.
Yeah.
But now that it's starting to slow down,
Mhm.
chances are it might not make sense to refinance anymore. And in that case scenario, like the one of the loans that we explored, a 10-year interest only followed by a conventional 30-year. So that's a 40-year loan.
Correct.
And I think we just made some calculations based on a buying price, let's say $1.7 million. You're paying almost, I think, $1 million more over the
Correct.
course of
That first 10 years is given straight to the bank. And
it's
then
like you're renting.
Correct. You're renting for that period of time. Now, typically, if people are going to take advantage of an interest-only loan, it's more likely higher net worth individuals that might be using those assets, that money, for something else, or they're choosing to make large principal reduction payments along the way, which every time you make a reduction payment to the principal, if you're doing that frequently, that's the key thing here, then, the amount of interest being paid reduces because the loan amount is less. If you're disciplined in that approach, or if you plan on using the funds for something else that might have a greater rate of return, it can make sense for some buyers. But I don't advise everyone to get in with an interest-only option.
And like for practical reasons to understand the comparison better, let's say you have interest only would be for the same type of borrowing amount, you'd have $7,000 a month versus $8,500.
Correct.
So you're saving $1,500 a month, but you're not paying down any equity.
Zero.
So what you were suggesting is if you take that $8,500 equity and you can't afford to pay the extra,
Yes.
you just you pay as if it's a conventional
Correct.
loan, and you're paying down towards to reduce the principal amount.
Absolutely. And then your interest amount is reducing along the way as well because the interest is calculated on the outstanding principal balance.
But I don't remember exactly. I think we did make the calculation as well. Let's say you do apples to apples.
Yes.
This loan and that loan, and you make exactly the same payment.
Mm-hmm.
There's still a premium at the end of the day for interest only.
There was
Just you basically getting a luxury of, if you can't pay a particular month, the full amount like you would have to be in a fixed loan environment, you can just pay the interest only.
It makes sense for people. Here's where I can see it makes sense. And I'll give you a real world example with the client I'm working with right now. They are an HR director for a large company. Okay. They are a 7-figure earner per year. Half of that is typically bonus, right? So they take the interest only because they live a lifestyle associated with a 7-figure income. They don't pay any principal. And when that bonus comes every year, they just throw it directly at the outstanding principal balance, right? That person will have their home paid off in the next probably 2 years, okay, because of where they're at as it stands today. I'm not saying everyone's going to have that level of income, but what I will see, the people that use this appropriately, they'll take a large chunk of money and pay that down every single year. Then there's potential that makes sense for people like that, because they get into a home that they otherwise, might have been tight just for the day-to-day living, but they know they have this that comes up each and every year, and it could make sense. Again, not for everyone. And I can walk people through if it makes sense or it doesn't, like you and I did.
Yeah.
When we did the math, it was like, well, no, that doesn't necessarily make sense unless...
In my particular
scenario,
correct. Yes. And for somebody, it might. That's, I think, the beauty, and it's great working with somebody like you that understands all the different options. I think when I started looking into buying a home, and I made a mistake not buying like 10 years ago, and I thought, okay, the prices are going to go down soon.
You're in that camp. You're not alone. There's a lot of people that...
12 years ago.
A lot of... And every year people are like, and you still say it today.
Yeah.
I think they're going to go down. I think they're going to go down, right? So it's hard to shake that mindset because everything we look at logically is like, it should go down.
It should. It's like the bubble just keeps growing and growing and growing.
Yeah.
It's the musical chairs.
It is.
And the chairs are running out.
Yeah.
But the point I'm trying to make is when you have options and you know those options exist, you can make a lot better purchase decisions or a lot more available to you.
Yes.
I'll give you a perfect example. When pandemic started, I did not know, or actually let me go backwards. When I started looking at the homes, I was so locked into not paying PMI insurance that I thought I have to get the 20%.
Yes.
So by the time I got to the 20%, the price kept jumping higher and higher. So that was like always a moving target.
Yes.
And then,
so you may as well take in the PMI.
Yes.
And then rebuy it when the value went up.
Exactly.
Yeah.
And also, as I'm saving the money keeps going down in value.
Correct.
It's like I'm getting double hit.
Yes.
The price is going up and the money is losing value.
Yes.
Might as well, take it with PMI. If you're going to live in the house, the one thing that I did learn, that if you can't afford to buy a house where you're not going to put yourself in a position that if the market goes down, you will have to abandon ship.
Yes.
Just buy it.
Yes.
Weather through any storm.
Yes.
Eventually it's going to go much higher than what it would be at a dip.
I think you just touched on what is probably the key point in this entire conversation.
If you're going to live in the house.
If you're going to live in the home, it's your primary residence, right? If you can, right? If you wait, historically, it continues to show us like waiting isn't necessarily the best strategy. Sometimes people might plan it correctly, but to your point, buy it now. If it's affordable, lock into a fixed rate. You know what your terms are, weather the storm. If you wait and try and time the market, it's difficult to do it. And the market can just run away and it costs you more money in the long run.
And the rent always goes up. I have never seen rent go down. Just, I don't know, in the last
It's gone up quite a bit. I've heard recently, and I've read some stuff recently that there might be, some dips in rent. I haven't seen it. Everywhere I look, it seems to be going up, but there's probably data in pockets where we might see some pullback in rent. But I will say this, 20 years from now, I know it's going to be more expensive.
Oh, yeah.
10 years from now, I know it's going to be more expensive. And this leads me into, you've probably heard about this. There's talks of a 50-year mortgage.
Yeah.
Have you heard this?
Trump was pushing for it.
So there's two camps on this, and I feel like, you were either on one or the other. There's very few people in the industry that are indifferent to it. It's like, it makes total sense to me, or that's the worst idea I've ever heard. And for me, it makes total sense to me because it creates affordability.
Yes.
Someone can get in. They know what that payment's going to be for 50 years. They can pay it off sooner. right? They're not obligated to keep it for 50 years and pay all that extra interest, but they're not going to have to worry about the payment changing if it's a fixed term. Whereas rent, 20, 30 years from now, like we were just discussing, could be substantially more than what your mortgage has been, right? And if you're buying early, I think this product really is helpful for people young, first-time home buyers, to be able to get into the market. The data shows about 4 years is how long most people hold on to their mortgage, right?
That's a very fascinating statistic.
It is.
It changes a lot of factors.
It does. And that could be a move-up scenario. That could be a move-down scenario. That could be change in lifestyle, jobs, whatever it may be that, forces people to either move or refinance. And the cycle we've been in over the last, 15, 16, how long are we now? 18 years. Time flies. Since 2008. A lot of times it's been because there's been a benefit at some point because the market's done this with rates. We were here and it kind of does this. And so at some point you can catch that wave. Hey, we can save you $500 a month. Let's refi. So you're either selling, moving, whatever the scenario may be there, or you're refinancing. So the average person stays in their mortgage around 4 years.
Yeah, that's a fascinating statistics knowing that, because then the terms that you're going to get now are not as critical as being able to just move into a place.
Yeah.
Because if you're going to have it for 4 years anyways, then it's not as critical.
Make sure you can afford that payment if it was 50 years, right? So don't do something where you're banking on some change that might save you or bail you out. But if you can afford the payment and you're comfortable, by all means, jump in. And then if the market presents opportunity to reduce the interest, take advantage of it. Or, like a lot of people, you end up moving or moving up or moving out, jobs, all those things.
Yeah, I'd say the rule of thumb would be what people were doing in 2007 and 6. They were banking on the housing going up, and then they just keep refinancing to take the money out to keep paying for the house. So that's the worst strategy you can possibly think. If you're buying, you should buy knowing that you can pay it off. Like, this is your comfort level, but there might be opportunities to refinance later.
Yes,
not as this is for sure what I'm gonna do.
Yeah,
not banking on the fact that real estate always moves up, because sometimes it doesn't. And when it doesn't, and you no longer can pay for it, that's when you go into a foreclosure.
The big thing that I saw that, there was a lot of catalysts to that collapse, but I owned a broker shop at that point during that period of time. And maybe a year or two before, I made a decision to stop doing certain types of products because I'm like, this is no longer making sense. I would see, peers have customers that were buying, investment properties hand over fist because the market continued to go up with zero down, zero proof of income, right? So you would, and I even knew friends that I bought 8 houses in the last year, no money down, right? Didn't have to prove how much I made. And it just kept going up, and they would refi, pull cash out as their value, try and buy more, figure out a way to leverage. And that was a big part of the collapse too, is no collateral required, no income required, and allowing it on investment properties. I don't live in it. When everything goes sideways, I can't afford the payment. I literally don't have money to pay it. I'll let it go. I'm going to keep paying or try and stay in the home that I live in. But all those investment properties, they were released immediately. I'm just going to let it go.
How much do you think of that as present now? They're still bad loans.
They're absolutely bad loans. There's a couple products that I think for smart investors, I use them quite a bit as it stands today. I think the difference between today and then was even products that, we might be leveraging lease agreements. There's a product called a DSCR loan, or a debt service coverage ratio loan. This loan is designed for real estate investors. We look at the lease agreement. We look at their history as a landlord to determine, hey, do they make sense? It does require typically 20 to 25% down, as well as reserves. So we're going to go off of, your lease is $5,000, all in your mortgage, taxes, insurance, association, if included, it's $4,000. We have $1,000 cushion in there. You have reserves. That product is a great product. If we open those guidelines up too much on that, I could see that one getting a little bit tricky. The difference, though, is people had to have skin in the game. They put money down in order to get into those properties, so there is some exposure. So I think anyone that's going to be putting money up is going to be, a little bit more cognizant and probably make those decisions differently than when it was just free money with no money down.
But how big of those? So I think here's a scenario that's very plausible. When the market dips, and it will dip, like I think much further than it has dipped to date, because since 2008, it's almost always been on going up, with few small pockets of time when it went down a few percent. But we haven't had a correction.
Yes.
I think the correction is coming. It's safe to assume it always does.
Yes.
So will it reach a critical point where people are so much in negative equity where they just give up their properties? And that would be a big chain reaction. That would be like a domino effect if we start seeing the foreclosure. I think it's very plausible, and I'll tell you why. Because a lot of the new purchases that are being made, people are still stretching themselves. Where, let's say, even if they do put 20% down, if they lose their job,
yes,
and the market goes 20% under,
yes,
that's a foreclosure.
Yeah,
like a certain foreclosure. It doesn't make sense to sell it at that point.
Yeah,
not even 20. It doesn't have to go down 20. Selling cost is around 6-7%.
Yeah.
Well, you take out the fees for the agent.
Yeah.
The closing costs.
Yep.
So the market has to go down for anybody that buys stuff, let's say in the last 2 years. If the market goes down 15% and they're already stretched thin as it is, or they lost their job, which might...
That to me is the bigger catalyst. I don't think people are going to walk away from a property they put money into just because it's upside down from where they bought it, if they're able to make the payment. If there is some economic hardship that comes into the picture where they simply can't make the payment, that creates challenges. But one thing that we learned in 2008 is, most servicers do not want to take properties. We learned that it's a cumbersome process. It's impactful to the families, that are, being displaced. It's easier to do some type of modification and find a payment that they can afford, and then tack on whatever that extra interest is to the back of the loan and help them weather this storm.
So like what they did during the pandemic, you pay you miss a few payments, but in the end you tack it on.
And they'll end up altering the terms. You have to go through and get approved to do this, but most servicers now would prefer to go that route
than foreclose.
Foreclosure is the last option, and they really do not want to do it. It's not beneficial to them in the long run. It's not beneficial to, the clients, everyone impacted. The market is impacted, right? So think about this. Selfishly, I guess from their standpoint, if the market gets impacted, to your point, to such a level that people are like, I'm done. Like, if I can't make my payments, I'm just going to let it go. It snowballs, right? So keeping those people in those homes, trying to help them avoid foreclosure, benefits the servicer and the lender just as much as it benefits the client over a long time.
I wasn't even aware that that's an option nowadays. See, that all of this information should be a lot more publicly available. I don't think people talk about it enough.
I will say this, in 2008, 2009, there were a lot of companies that popped up that were loan modification companies. They would collect an advance fee to try and negotiate terms. The lenders now and the servicers are pretty good at doing this directly. So to anyone that might be experiencing challenges right now, pick up the phone and call them directly. Don't run from it. Don't hide from it. Don't wait 60, 90 days for this to escalate with no payments being made. Your lender wants to know that.
Do you know how to do this?
You can just call directly. You grab your mortgage statement. There'll be a 800 number or whatever number on there. Call that servicer directly and say, look, I'm experiencing hardship. I need some help. What can we do to work on this? They'll walk you through a process directly. You don't even have to go to someone necessarily to get assistance. Most servicers now, because of what happened in 2008, have a process in place to try and help with this.
So what's the bottom line there? They push it off. Do they reduce your payments, or they
do
you not pay at all for a certain amount of time?
So typically not a don't pay at all. What'll end up happening, from what I've seen, and again, this is, secondary to what I do, but I see enough of it, and I've seen enough of it after, 25 years in this business, especially with what's happened over the last few years. And prior to coming to West Capital Lending, I was a vice president with Chase Bank So I saw, they're a very, very large servicer. I saw how they navigated this and what they learned from that. So this applies. And I've had family members and friends that have had some hardships come to me. We talked about it and I said, don't wait. You've missed a payment. It's okay, right? It's not the end of the world, but don't sit on this and just hope things get better. If the servicer thinks that you've just given up or walked away, they're going to be left with no choice but to start looking at, the worst case scenario. So you pick up the phone, you call them and say, I'm experiencing economic hardship. Usually what they'll do is they'll take those missed payments, move it to the back of the loan. Oftentimes they'll restructure, dropping your rate. You have to document the hardship. You can't just call up and try and leverage, be opportunistic with it.
Show basically you lost.
I lost my job. My spouse lost their job. We had medical issue, whatever it may be. You're going to document that.
Awesome that even exists. I wasn't even aware that that's something.
So again, I think, one of the reasons, like foreclosures, I looked this up prior to coming today. I think we are at 1/4% right now of all properties.
Which is like crazy low.
It is. It's extremely low. Anything under 1% usually is going to be a normalized market. So, it's low. It's very low, but I think a lot of that has to do with the fact that servicers are now, hey, let's find a way to work together to support this. Because to your point, anyone that's bought in the last 3 to 4 years, 5 years, with 2020 being the catalyst of things really taking off, you could see some pockets, depending upon where you bought and when you bought, that we might see a dip. But a normal market is 3% appreciation per year stretched over a long period of time. In there, you'll have dips just like anything else.
Right.
I don't think that there's going to be a massive pullback personally, unless there is a tremendous economic hardship. So then we got to look at, things from a macro level, the big disruptor for every industry right now that's not moving atoms out, shoveling dirt, fixing your plumbing, it's AI. So what does that do from an economic perspective? I don't have the answers to that. So could that be a catalyst to potentially a market dip? I don't know. Or does that make us more efficient and we earn more and it causes prices to go up? I don't know. I don't know what that looks like.
There's definitely going to be some interesting transitional period with AI. More and more jobs are going to be lost. That's inevitable.
It is.
And unless I think the government steps up, and this is where I think the government can be very useful, is to restructure resources where you redirect them. Let's say the AIs, because they're cutting so many jobs, you have incredible efficiencies.
Yes.
And unless those are pocketed in just a few pockets and not redistributed, you will create this huge gap between classes and you will create all sorts of problems.
Yeah.
But if they will use the efficiencies to restructure economy, that would be hugely beneficial. Even if it comes down to universal income or whatever it is, I'm usually not for those type of
You and I are on the same page, but
however,
yes.
What do you do when you no longer need to work?
How do you displace that many people and what does that look like? I mean,
there will just not be enough jobs. That's a fact.
Yeah.
So I think but it will create incredible economic efficiencies.
It will.
So that's where possibly some semblance of socialism might actually be useful.
And you and I are on the same page with that, right? Like I feel the same way. But in that scenario, what do you do? I don't have an answer to.
I think universal income.
That's the only thing I can see being a potential, way to solve for that very big issue.
I just actually heard, again, I don't know, it's hard to verify what's true or not anymore with AI. They're making up stuff.
Right? Videos, all of it. Yeah.
But I think this is legit. I have to do some research on this. I've heard that Trump is trying to create, I forgot what it's called, American Learning, whatever thing.
Okay.
You heard this?
No, I haven't heard this.
Basically a government college education program.
Okay.
Where they will, I hope I'm not quoting like complete nonsense, but this is what I heard.
Yeah.
They will tax the colleges that are overcharging, whatever they're going to do. It's find ways to pull money out of them.
Okay.
Create this government education program, leveraging AI, all the knowledge and accredit it and make it free. So you can have education for free essentially through the government, which is an interesting proposition if they can pull it off.
I feel like I get more, out of technology. I like doing my own research than I ever did previously.
Oh, now you don't have to be an expert in anything. You have the phone.
Yeah.
Like, you don't even need to go to, well, doctors are still, they need to touch you or whatever. But
Yes.
if you want to have
Certain
information,
questions, yes.
it's like you have it at the tip of your hand, like boom, touch, and you got it.
Yeah.
Yeah. And
Interesting idea.
In fact, like when I'm hiring people now,
Yes.
you know what I'm looking for?
What are you looking for?
Not even like crazy knowledge, education, or experience.
Yeah.
I'm looking for people that show up on time.
Yeah.
That have decent work ethics.
Yes.
Honest.
Yes.
Those are the fundamentals, because if they show up on time,
Yeah.
they can sit through the whole day.
Yeah.
And be honest about what they've done during the day.
Yeah.
They can be experts in anything.
Yeah.
I can teach a high school student, to be almost like a PhD professor in physics. Just leverage AI.
Yeah.
But if you don't show up on time, or you're lying to me about what you've done during the day, then it's not going to work.
It's interesting that that's the barrier now.
Just be a decent person.
Yeah. Show up, do your job, be coachable, ready to learn, try and contribute, right? It doesn't require as much, and it's harder to find, unfortunately.
Yeah.
I'm hiring too. So I'm always trying to bring on, new talent and help shape people as, the next generation tries to come up in a business that's going to be substantially different than the one I've been in for the last, 25 years. Our business, just like all of them, we're going to get disrupted by this for sure.
In what way? What do you think?
There'll be less of a need for as many mortgage loan originators. I think AI will create efficiencies where, at least at a scale like a West Capital Lending, we have 1,200 or so, give or take, mortgage loan originators. A lot of these people have, relationships, but a lot of this is also, direct consumer marketing that happens online. Customers fill things out online. It triggers a form. We make a call. We try and find solutions to help solve for their issues. So when you look at large scale, non-bank lenders, call centers, as we've called them over the years, that might buy, leads from a lending tree, for example. We will need less people to answer the phones to get in front of those leads. AI will probably make a phone call. We'll reach out. The chat bot will do a lot of that communication, which I'm already leveraging now, and it's getting pretty good. I came in the other day. I had a client that did not speak English. So with our tech stack, certain things go out when the lead comes in. There's an immediate response. My AI bot, the person responded in Spanish. The AI bot recognized it was Spanish and had an entire conversation in Spanish, all the way to the point of answering questions outside of things, that are related to, pricing loans and things that AI is not obviously licensed or capable of doing. But I could go then and translate all that and get back on the phone with this person, and already know exactly what they're looking for, all in Spanish. I didn't have to do anything.
Wow. So, that cuts out a lot of the, let's say, quote unquote, assistance.
Correct.
But not the principal people, the key people like yourself that are licensed and doing like the heavy lifting. But
yes,
at what point you are replaced and I am replaced, let's say in your field.
Yes.
When is AI ready to do from A to Z? I don't think that's far off either.
I don't think it's far off. I think this business is still going to be relationship based. I think AI is the greatest opportunity for this transition to occur.
Let me ask you, why does it have to be relationship based?
On one of the largest financial decisions people will make, they still want reassurance from a human.
That's interesting.
Now,
emotional,
but that's today. As we become more and more in tune generationally with communicating directly with AI, will we become more comfortable with it and not need necessarily that handhold or that, let me just double check with my years of experience to make sure? AI has never bought a home, right? But you have. So walk me through some of this stuff. So I think for the time being, and with realtors, they're not going to want to reach out to AI. Hey, I have this customer. Here's some of the challenges. How do we solve this? But I think in time, generationally, that could change as people get more comfortable communicating directly with AI.
So I think almost inevitable, but I do like where you're heading with empathy and emotional support. I think that is a very human thing. That might be harder for AI to recreate. But from knowledge point of view, the experience to buy a home, I think that's easily solvable. AI can go through the whole
Yes.
I think scenario
Yes.
from A to Z, everything is digital now.
Yes.
You can buy the house. You can communicate with all the necessary parties. Will it feel you
Yes.
and cater to your feelings? That's probably where, but you can have maybe
It probably will. I mean, it's learning, right?
over
So
time.
it will. And I feel like, if you communicate enough with AI, it starts to understand you, and the responses you can feel are kind of tailored to you or your personality or, kind of how you operate. The one thing that I still don't understand yet, how they're going to navigate this, and I'm sure, if it's not being thought about, it will be. This is a heavily regulated industry, especially after 2008. So for non-bank related lenders like myself, we have to be licensed in every single state that we do business in, which means education every year, testing every year, right? We have to pay every year. I know that is an income stream, but how does that work with AI? Does it have to show that it's been given all that same education or update?
But
what's the regulatory part that's going to come into that kind of locks down AI and keeps it on the same path that a human is on right now, with making sure if you're using AI, it meets whatever the educational requirements are or changes to laws in the industry?
I think it's going to be far, far, far more efficient than us.
I think so too.
Because you can just feed it information, make sure it doesn't have some kind of training bias in one way. You can give it tests, certify it. And once you do it a single time, you don't have to retrain it like a human that forgets things. And you upload the new laws and regulations, and we'll just keep getting better and better. It's far more efficient than a human being.
For sure.
1,000 transactions in probably a few seconds versus a human that's limited to that human interaction.
So then it'll be, what I see on this is there's going to be an opportunity for anyone listening that is in that space to create an AI that is now compliant and meets whatever regulations are going to come. And that will be the provider. I have a feeling you'll see certain providers that are specific to industries that are heavily regulated, that have approved, coursework or training or whatever for AI, that people will start to trust. I know I'll remain compliant if I use XYZ company that is kind of geared around my industry. So I think you'll see opportunities for, companies, at least for a period of time, to pop up with things that are, compliant based on whatever future regulations come.
Yeah, it's like lawyers too. They're becoming so dependent on AI to go through all the cases. And again, they can be compliant. They can be compliant in all the laws and regulations.
Mm-hmm.
But I think one thing you touched upon, that's the human experience. And maybe you're right. Generationally, it will just fade away. I hope not.
I hope not too.
I like to talk to somebody.
I do too.
It's a wild thing. I don't think we've ever had historically a point in where it's just so uncertain what's going to happen.
Yeah.
You could always predict somewhat the trajectory of where humanity is going.
Yes.
At this point, we're reached like a event horizon where you literally don't know what's beyond.
Yeah.
And it could go 1,000 different
ways. And then
ways.
you talk about, it's the wearables and implants and all these things. Like it continues to, expand the human potential, right? But what does that look like? All of this, we're on a cliff and we have no idea what is at the bottom of that cliff or at the top. I look at it,
Yeah. One thing for certain, people will still need real estate.
They will. So you're going to have somewhere to live, right? You're going to need somewhere to live. That's for sure.
Hopefully it's going to get easier to borrow money. Hopefully people won't even need to borrow money. I think at the end of the day, it has to be even if money is flowing to pockets of very few companies or people, I would imagine at a certain point, you'll be like, I really don't need this much.
Yeah.
Elon Musk is worth $700 billion now.
That's what the number is now?
As of January 2026 or December.
Yeah. He was long past the point of, I don't need this much, right? That happened.
Well, for him specifically, maybe he does.
Yeah.
Because he's going...
I'm going to go to Mars and I got to fund all these other projects. Yeah.
For that, but I think he's contributing to society.
Yeah.
Somebody actually asked him once, don't you think it's wrong for you to have so much money?
Yeah.
And he says, it's not it's not wrong to have money. It's wrong to consume money for personal reasons.
Yes.
I don't even own a property as of today.
Yeah.
I live in like a tiny little cubicle.
Yeah.
I dedicate most of my time working.
Yeah.
Even when I travel private, it's to make me more efficient.
Yes.
He doesn't splurge.
Yeah.
I don't think he has a huge yacht he's traveling on.
Funny, what do you have to prove at that point, right? Like his goals and where he's going and what he's trying to leave behind, his legacy is, a lot different than, the flex of, look at all the things that I have, which, I appreciate.
Well, the flex is even worse than personal consumption.
Yeah.
Personal consumption, I think that's where how you can evaluate. I think flex altogether is wrong.
Yeah.
That's just pure wrong.
Yeah.
At least personal consumption, maybe you can justify somehow. You know what? I have higher standards.
Yeah.
I want a little bit nicer quality of life.
Yeah.
But to what end? That's the key, right?
It is.
And can you judge somebody for having, let's say, a 5,000 square foot house versus 2? Not really.
Yeah.
If you can't afford, why not? But can you judge somebody for having 10 yachts versus 1 yacht?
Yeah. Yeah. How many do you need? Yeah.
And there are people that literally have so much that they just buy because they can.
Yeah.
Whereas, again, Elon Musk, to his defense,
Yeah.
and I don't know how true all of it is,
Yeah.
but on the surface,
Yeah.
he's using his funds for making humans multiplanetary species.
Yeah.
You do need $700 billion
Yeah.
for that. You need more.
Yeah.
And I think I'm a religious person.
Yes.
I believe God controls all things in life.
Yeah.
And even a person's income is somewhat determined by God's distributing resources.
Okay.
I think Elon actually does deserve it. He needs it. He's entrusted with the greatest wealth a human has ever had in human history, because I think he has SpaceX, which is, again, creating ability for us to be multiplanetary.
Yeah.
He has electric car company, which makes us more efficient in transportation.
Yeah.
He has the social media, which improves our communication. He has a boring company that allows us to dig under and find more space.
Yeah.
He has an AI company that, again, all of these are improving efficiencies. Starlink.
Yeah.
All of these improving efficiencies of humanity.
Yeah.
So if he makes more money, the way he distributes it, not through charity is also, I love charity.
Yeah.
I give a lot in charity.
Yeah.
But what's better, to give somebody work or just giving handouts?
Yeah.
Work is better.
Agreed.
In the way
we all need some type of purpose.
Instead of just giving all the money up, he's reinvesting it back in humanity, which I find the most admirable.
Mm-hmm.
And I hope that's how it's going to progress. Mm-hmm. Let's say all of these major companies that will have the tremendous benefit from the efficiencies that AI will create, they will just not just even give handouts, they will literally reinvest it into making humanity not depending on any resources anymore.
Yeah.
Like, let's be able to build a house for $5.
Yeah.
Then you don't need...
it's interesting. I mean, I don't know if you've seen this. You bring up housing. The big thing, we got so many challenges that we're facing. We don't have enough affordable houses, right? So we need to build more, right? But then on the other side to that is, population decline. So it's funny, the things that we're working through. But one of the things I've seen, I don't know if you've seen these. Have you seen the concrete homes?
Yeah, the 3D print.
Yeah, they 3D print in like a few days. And it seems like when you look at, fire areas, the hurricanes, tornadoes, all these places, I don't know structurally, seems like it would make more sense. I haven't done a ton of research on it, but pretty cool, some of the technologies that are coming. And again, I could see AI running even that.
Yeah, everything.
Yeah.
Some people say, the plumbers will still have their job.
Yeah.
Maybe. Short term.
Yeah.
But the robotics are advancing. I saw the clip from CES.
Yeah.
Boston Dynamics released their newest robot.
Yeah.
The thing walks like better than humans now. So at what point will they have better dexterity than us?
Yeah.
You can create a robot that has multiple joints, fingers, whatever, that's far more superior doing plumbing.
Yeah.
And do you really need a human body to do plumbing?
Yeah.
Probably not. The intelligence already can be replaced. But
if it's connected to the cloud too, it's got infinite resources potentially at the same time. So the problem solving, it's like, I'm looking at this, boom, let's
hook it up to like the detectors. Let's say put sensors, just comes to the house, senses the problem like that.
Yeah.
goes exact, not like a normal human plumber that has to dig up half of the house to figure out where the leak is. Just boom, it's right there. 2 seconds repaired. Boom. It's coming. It's coming.
It is. It is.
But then it goes back to, do you need money at that point? Let's say, today we need a job. You need to make $200,000 a year or whatever to make comfortable life, because you need to have to pay for a house, food, whatever resources. But if you have abundance of all the resources, you have virtually infinite amount of space if we learn how to build up or down or whatever way they find more space. And even the construction itself costs nothing because it's all done by robotics with infinite amount of energy. Like once they figure out whatever is the next renewable thing, the sort of nuclear fusion, then you have production of all goods and materials. Infinite amount of it.
It's in a weird spot, right? Like, I don't even know what that looks like, because now I feel like, once again, it's more government intervention to try and manage all of these things, and that kind of scares me. I do like the idea of autonomy. I do like the idea of... Yep. I do like the idea of, I want to live here versus there. I don't necessarily want to live in stacked housing, but I can see why it's efficient. I can see why it makes sense. I just, that concerns me. I like, how it's set up on one hand now, but I get with AI coming, who knows?
The way it's going to put us in the efficient boxes.
It is. And, you hear things like that online too, that we're making, cities into these efficient boxes where cars might not be necessary, and, everything is stacked one on top of another. I don't know. I feel like we need more connection to nature, not less. And if we're just stacking the things one on top of another, we get away from kind of what makes us human in the first place.
Well, that's a bigger question.
Yeah. Outside of housing, right?
Are we still going to be human?
I know.
The scenario that I've heard about, and it's very plausible, that at some point that we are going to be so far behind AI that the only way to stay relevant is to be completely in sync with it.
Correct.
Almost like Borg, remember in this Star Trek?
Yes.
To have some form of a hybrid human,
which I think they're already working on, right?
Yeah, that's another Elon.
I was just going to say that. Yeah.
What is it called? Neuralink.
Yeah.
And then at that point, are we still human? If we have collective consciousness. I don't know if you watched the movie Pluribus, this TV show on Apple TV.
I started it. I haven't watched. Okay, to know.
I love that show.
Okay. It seems very popular.
One.
Yeah.
But the whole premise is, there was a alien virus.
Okay.
That they transmitted something. They picked up a signal from another planet.
Yeah.
They tried to create this thing. It turned out to be kind of like a virus that infected all of humanity except maybe like 12 people or whatever.
Yeah.
And the way it infected them is everybody became a collective consciousness.
Got it.
And now the question is, are they still human or not?
I mean, I guess you go back to the most fundamental question: what makes us human?
True. And is that the individuality or not the individuality?
Yeah. But at a soul level, like, there's so many things that, and then is that already part of the collective? I don't know.
And
fascinating times, that's for sure.
When you are collective consciousness, things drastically change.
Yeah.
You don't maybe need certain things or the way you interact.
Yes.
All of these, it's just a different world.
It is.
And we are like, we think that we're limited by what we know.
Yeah.
And I think that's one of the things that's going to be absolutely crazy is there's so many things that we'll discover that we thought were impossible. So even if you say like you want to be in nature, maybe there is a way to experience being in nature even when you're not.
Yes. Some kind of virtual.
Yeah. Do you really need to be in the nature? Yeah. You can feel and sense it and whatever.
Yeah.
Do you need to eat
does that simulate
healthy if you can just take a pill and everything is perfect?
Yeah.
Unknown times.
Yeah.
But anyways, back to where we were, and we need to conclude at some point.
Yes.
I love all of these topics, but we're back to reality.
Yeah.
Getting a house now is very important.
It is.
And the prediction is your prediction, if you want to take one.
Over the next, what timeline?
12 months.
12 months. So If rates do come down, we do have a lot of people on the sidelines that are pre-approved, but the affordability isn't quite there yet, right? And there's also not inventory. So what I will say is my prediction, and there'll be counters to this, and I'm sure the counters are valid. So, everyone's going to interpret the data and, listen to all the different inputs and make a decision on their own. But I think if we have a significant amount of reductions in rates and mortgage rates do drop, it's going to increase that affordability. I think you'll see more homes get listed because people will be able to move and feel like I can still get in at a low rate somewhere else. Inventory is going to increase. I think you'll see prices go up. So, that might be contrary to others, but I think if the affordability gets to a point where, we hit that tipping point where people will list more available inventory, and now there's more competition again in the marketplace, I think you'll see home values increase and purchase prices go up in the next 12 months. But that's going to be dependent upon the economy and what happens with mortgage interest rates over the next 12 months.
I think that sounds very logical. I will say that here's another possible scenario, that if the home price, if the number of homes will increase in the inventory, more people will be able to list their homes. Because we are now, I think, according to Zillow, it's a buyer's market on the index. If the mentality is already set that I should wait a little bit longer because you actually see the prices dropping, and all of a sudden homes start getting listed, and it only increases the problem further, that the prices will keep dropping because supply is increasing. There is a chance that it will hit that critical point.
Yeah.
Where the bubble will pop.
Could be.
Because I still think genuinely we're in a bubble. It has to be we're in a bubble. So it could go two directions.
Those are the two outcomes. The third one is it stays flat, right?
Which is also plausible because as you're increasing the inventory and as you're increasing the buyer power, they just balance each other out.
Correct.
It could stay flat.
It could.
If I had to guess, and we'll revisit this in 12 months.
Yeah, it's a good idea, actually. We'll see where we end up.
Yeah. I think there is a chance that it will be more of a correction than we think.
Okay.
Because there's so many things happening in the world, especially politically, geopolitically. It's a little bit volatile. It's probably due, but I will still probably try to buy a house regardless. Because as we said before, you got to have a place to live.
You do.
And besides the fact that the rent might be always cheaper than the mortgage.
Yes.
Just being at the mercy of the landlord, as you and I discussed before the podcast. I don't want to go into the details.
Yeah.
It sucks.
It does.
I want to be in control of my own destiny to some extent.
Yeah.
That alone is worth the price of admission.
It is. And then I'm not a accountant. I'm not a tax preparer. But typically, homeownership does have some advantages, too, from a tax perspective with, potential deductions.
Right.
So always, of course, talk to, your financial, advisor and your tax preparer. But, there's that other part to it. And your rental's never going to appreciate for you, right? We know that. It's a 100% certainty that you're not going to make, a return on your rent. A property, you do have that opportunity. So tax potential benefits and then the potential for appreciation. And you don't have to worry about a landlord.
Yeah, and even the rate for rent itself, it might go down, but look at 2008. It actually shot up because people lost their homes and they needed to rent.
Correct.
So even if the market goes down to buy, the rent might still go up, which is almost counterintuitive, but it's not.
But all of a sudden you have a market flooded with renters and it's supply and demand once again, right? Yeah. So at the end of the day, that same principle always comes into play. 12 months from now, we'll see how supply and demand played out.
Yeah. And when it comes to tax deduction, just so people can understand, you have about up to $1 million in interest that you can write off per year?
Yes. $1 million. Well, it depends on when you got your loan. But yes, typically it's up to not $1 million in interest, $1 million of your loan balance. So the interest associated with the first $1 million of your loan. So let's say you paid, $40,000 in interest on that $1 million. You might have a loan for 1.5. You can only deduct the interest up to a certain balance of that loan amount. You can potentially deduct it. Sometimes that itemization and that deduction doesn't make sense, again, talk to your tax preparer. But yes, there is some caps to that, that people need to be aware of. But the property taxes too sometimes can be, something that you can look at as a deduction as well. But tax law changes all the time. There was talk about removing the mortgage interest rate reduction and somehow applying that to something else, but that hadn't happened yet.
Let's just do a quick example and we'll conclude after that because time's running out. Let's say if somebody bought a house for $1 million, which is not available here, but let's say they did, on $1 million and average interest rate is 6%.
It's called 6.
How much do they pay in interest over the course of a year?
So
ballpark.
Simple interest, right? The way mortgages work is you're pretty heavily loaded on interest in the beginning and a little bit goes towards principal, and it's kind of like a teeter-totter. The longer you're in the loan, that starts to shift from interest being the majority of the payment to principal being majority of the payment.
Let's say the first few years.
So first few years, let's say it's an $800,000 loan at 6%. That's $48,000 for the year on simple interest.
So that they can deduct from their income. So if they're in the income bracket that's 30% or something, or let's say average 25, 30 after all say 25. You're saving 25% of the 46,000. You said 46,000?
48.
48. So that's $12,000 in pure savings on your tax return. So that's $1,000 a month.
Keep in mind,
that's pretty good.
It is. Keep in mind the standard deductions go away, right? So if you start itemizing, and again, I'm not an accountant,
it's interesting,
but it's, typically one or the other. You're either going to itemize or you're going to take whatever the standard is based on your filing status.
For, I think, a lot of business owners, entrepreneurs, it's almost certain that they're not going to do standard deductions.
Correct. So you're already going to be itemizing your deductions. And oftentimes, especially here, it usually does make sense, to itemize and go that route because of the amount of interest that gets paid.
So if there's a gap between rent and mortgage, let's say the rent costs $5,000, the mortgage costs $8,000. After the deductions, if you think about it, you're really paying $7,000.
Correct. And then there could be some deductions in there for the property taxes as well.
Yeah. So that's all of these things I think people need to be educated on to enable them to make that purchase decision.
Yeah.
And again, I think it would be very rational for people, if they can buy, they should just buy regardless of where the market is. As long as they like the place that they're going to live in.
Yep.
Lock it in.
Yep.
Not having to worry about lease expiring, things breaking that the landlord doesn't want to fix.
Correct.
All these other factors.
The landlord wants to sell.
Rent raising,
all these things, right? You have limited control in that seat. California is pretty tenant friendly. Some states are not. But, you still are at the mercy of the landlord.
Yeah.
Right. And I get it. Some people, they've owned a home for a period of time and they're like, I'm getting older. I'm done. I just want to cash out. Unfortunately, as a tenant, you're stuck with whatever decisions the landlord ultimately chooses to make.
Okay, so my word of advice is find somebody knowledgeable to help you with your loan.
Agreed.
We have Audie here.
Yes.
How can people reach you?
All right. Easiest way is my cell phone. It comes direct, 949-785-5827.
Okay, we'll put it on the screen. Note to the editor.
I did. So we're talking about AI. I used a service called Replit. I put together a website, audiegarner.com, AUDIGARNER.com. You can fill out a form on that website. It's basic. I'm just playing around with it. It is live, but they could also go there and just put in simple information, and I can reach back out that way as well.
And which areas do you cover? Can people call you from other states as well?
They can. So currently I'm licensed in 20 states. By the end of this month, it will be 27. But if you, shoot me a text or even jump onto my website, it tells you all the states that I'm licensed in. Predominantly the states where, there's the most activity occurring.
Awesome.
Yeah.
Well, thank you for your time.
Yeah, thank you.
It was a pleasure.
Yes, it was.
I'll have you back.
Yeah.
We'll reevaluate our predictions.
Yeah, sounds good.
And I think there's a few more things we can cover in the future. I would like to do in the future.
Yeah.
Maybe go through actual scenarios.
Yes.
Financial possibilities, like look at some homes, for example, and I'll run through the
numbers. That's a great idea. So people can see real world what that looks like. Yeah. I'd come back before 12 months if you wanted to do that too.
Let's do it.
Cool.
Sounds
good. All right.
Thank you.
Thank you.